All right, hey there. Good morning, everybody. Christopher Inks with Texas West Capital coming at you live just a few minutes after 11 a.m. Central Standard Time here on Friday, the 3rd of March, 2023, 3/3/2023. Coming at you live from just north of Houston, Texas on Lake Conroe. Good to have you all checking in, man. A lot of stuff going on. Everybody freaking out. Everybody losing the damn mind. But why? It doesn't really matter, right? We'll talk about it here in a minute. As always, if you haven't yet, don't forget to hit the like. Don't forget to subscribe to our channels here on Twitch and YouTube. Follow me on Twitter at TX West Capital. And, of course, everywhere else online that we happen to be. We've even got a TikTok if you guys can find us out there. But I'm going to be producing more short-form videos for you guys. I tried out a few. People seem to like them, so we're going to start getting this more consistently. Both Reels type things, shorts, minute or less videos, as well as 6 to 10 minute video and clips and stuff like that. So, man, things are definitely popping up here. Going to get you a lot more content, a lot more information coming out. So be sure to check in there, all right? How are you guys doing? All right. Andrew says, going to oil. No, going to zero. Oh, okay. Yeah, see, you said oil, and I was thinking about what I posted this morning about oil there. If you guys, I don't know any of you guys that may be in oil, but there was a nice 4-hour candle first thing this morning, and natural gas looks like it wants to push up a bit higher before it does some kind of pullback. So we'll try to get into all that. Teo, what's up, buddy? Good to see you. Melissa checking in. How are you, ma'am? Ilya is here. Andrew Bennett, Nevlusian, Aeroquin Data. Good to have you guys here. As always, if you guys aren't involved yet, you can join us at howtotradetowin.com. We'd love to have you there. Specifically, you were going to get a ton out of our mentor program, howtotradetowin.com/LMT. You can join right here. You can join right here. But that's a year-long program, guys. And that program, it teaches one of my trading systems, a couple of versions of that. I've just added something new. As our members know, another thing I'm going to be teaching them coming up here, which is pretty great, pretty awesome. But really, the program itself, guys, is just about getting you psychologically and emotionally where you need to be, okay? But there's a whole bunch of stuff in that program. You can join. You can check out that page there to check it out. If you got any questions, feel free to send me an email at christopher.inks@texaswestcapital.com, or, hey, better yet, join our Discord server there, guys. And then you can DM me personally on there. As a matter of fact, let me see if I can find that link for you real quick before I get into this. Let's see. Here we go. All right, there we go. I got that link in there for you guys. All right. That'll get you over to our Discord server. So anyway, let's see here. Dan, what's up? Says, heck of a candle plus fall through. Yeah, man. I think you were the one that mentioned, that spoke, that responded there on the tweet this morning, right? Yeah, man. That was a heck of a good move there. It came off great. Timaswani, what's up, man? How you enjoying today's energy trading, man? All right, so here you go. There we got it, right? Let's talk about a few things, though. First here, guys. Let me see here. Do I have my notes? Oh, my gosh. Let me see if I can get my notes here, guys. Oh. I had to restart my computer. It froze up on me, and I had to get my notes up there, all right? Because there are a couple things I wanted to talk about, guys. So many of you are confused, right? You're confused about what's going on in here. You're very bearish because we were in a year-long almost, bearish just downtrend, right? Stocks and crypto. Dollar continued to rally there, right? And now the dollar seems topped out, but you still have all that chatter going on behind your head, right? You got a lot of big accounts still talking about how we have to go down, right? Some of them believe it. Some of them are emotionally, I hate to say it, guys, but they really aren't much more advanced than what you are if you're a new trader, right? They market well. That's what it is. They're marketers, okay? So you got to be careful with that. Let me see here. Fibbo says energy trading is never boring. Yeah. So, but they're going to be up there and they're telling you, listen, it has to go down, it has to go down. And you're like, well, it feels like that because, you're saying to yourself, listen, I don't know what's going on, so I'm scared. But, Chris is over here saying, man, it looks like a bottom. He's giving a good story, based on price action and volume and all these different things you're looking at. But, man, I'm scared to get in, right? So I've missed all this 60% rally on Bitcoin alone, hundreds of percent on different alts and whatever because I've been too scared to get in. What am I going to do? I'm freaking out. I don't know what to do. Well, the first thing is position size, okay? the biggest issue that people have, the reason why they get so emotional is because their position size is too large. You guys have to understand proper risk management, which includes proper position sizing. It doesn't mean 50 times leverage on everything you got and whatnot, and just kind of YOLO. That's going to get you lost money. That's going to make you scared. That's going to make it unable, even if you know how to use the system you're using, to follow through with that system that you're using, okay? It's going to bring a lot of emotion, a lot of fear into it. Hey there, Mark, Kimosabi, good to see you guys. Deadly123 is here. Good to see you, buddy. But anyway, so that's going to be the big issue there, right? And you go, okay, but Chris, everybody's talking about, man, the yield curve inversion, man, and that always tells us there's a recession coming. Well, it doesn't always, guys. Significantly, a lot of the time it has over the last 50, 60 years, but not every time, okay? You say, oh, but these guys are out there and they're claiming to be macro guys and they're saying, listen, man, the macro this and that, and that's why we're going to have this huge depression and this huge recession coming in. And you guys know, I feel like that's coming up, but I think we've got a little bit further upside now before we do that. I think we've got new all-time highs coming in with risk assets like stocks, and crypto before that happens, right? A lot of that is also pointed to because, the dollar, the DXY, the dollar's been dropping against its baskets of currencies, right? So the DXY is coming off that 115 area that we talked about was the target way back in whatever it was, 2001, January, whatever, when we were down, near 89 or 90 or whatever it was. And, that was the target. Said, looks like the bottom's in, that's the target, right? So we're overall, guys, we're doing what I expect to do, right? And then people are talking about, oh, well, the Fed. Oh, man, the Fed's going to keep raising rates, and that's going to keep killing off the economy and this and that, right? And oh, my gosh, the January job number. Man, that was so huge. It was a huge surprise to the upside. There's no way the Fed isn't going to continue to pop up. And, man, now they're probably going to do 50 basis points next time. And they're going to keep on raising it. So there's all this going on, right? And I understand that. I get that, right? But let's look at a few things today that may kind of hopefully give you some food to process, some thought to process on what may actually be going on and why these things that the doomsdayers right now are kind of saying may not actually come to, okay? So the first thing is we had the 2-year treasury, right? So we're looking at the yield curve. We're looking at the 2-year inverted with the 10-year, right? So the 2-year treasury yield was like right around 4.39 yesterday, 4.39%, okay? Now, that's almost the highest it's been since 2007. 2007 being right prior to the 2008, 2009, global financial crisis, right? Or great financial crisis, I'm sorry, the GFC. Now, the 10-year, though, here's the thing. The 10 years at 4.08. It's not that far off, okay? Now, when we look at those things, the 10-year is the big one, right? Everybody kind of watches the 10-year. Why do they watch the 10-year? If you don't know that's the case, well, that's the case, okay? But why do they watch it? They watch it, the 10-year basically, it's the benchmark for the U.S. mortgage rates, right? So if you want to know where the U.S. mortgage rates are heading, you watch the 10-year, right? It's kind of this big, your overall economy thing. Why is it for the benchmark for the mortgage rates? Because it's kind of your overall health of the economy. Okay. And so if it's the overall health of the economy and it's kind of your benchmark for your mortgage rates, right? Well, then it stands to reason that it's basically an overall sentiment check for the market participants, right? Does that make sense? And so you've got this, this pretty high, 4.08%. It's not that far off from the 4.39 of the 2-year. So even though we've got that inversion, we've got a high end with that 10, right? With that 10-year. So that longer term rate though, why is that important? Because that longer term rate suggests that people, the market participants are actually, bullish about the future, right? So we usually look at the yield inversion, right? The yield curve inversion, because what that tells us is people are more worried about today than they are about tomorrow. So you want the interest rate to be higher for today than for tomorrow, right? And generally that's what we're looking at. But in this case, that 10-year is so high, that 10-year is telling us that the people, even though they're still a little bit more worried about today than tomorrow, in the grand scheme of things, tomorrow, they're feeling like it's looking pretty good. So, you have to take that into consideration, right? It's not just simply, the yield curve's inverted, right? This is what I keep telling, this is why I tell you guys, macro is difficult. This is why often macro experts, right, PhDs and whatnot, get it wrong. How often does Paul Krugman get it wrong, right? Nobel economist gets it wrong a lot, right? Because there's a lot of moving parts. And, something I've been talking about for years now is this idea that we're really kind of pushing this credit economy, right? So if you guys don't understand, first of all, we are a credit-based society, right? We're a debt-based society, which means you need inflation. You need inflation because you're purposely taking on debt. And inflation makes today's debt cheaper to pay tomorrow, right? So you need some level of inflation to go on. Now, I'm not saying you need 9% or 10%, right? The Fed has a 2% rate that they try to get, right? But if you don't have that inflation, guys, it means, and you start getting disinflationary, which is the rate starts falling, right? The inflation starts falling. It's disinflation. Or heaven forbid you get deflation, right? Deflation means your debt today is more expensive tomorrow. Every one of y'all, if you're in a Western society, have likely got debt, right? Homes, cars, credit cards, whatever, student loan, right? That stuff gets more expensive tomorrow and the next day if you have deflation, okay? Inflation makes it cheaper, right? So we are a debt-based society that everybody's on credit, right? Everything's on credit, right? So if we're looking at that, and this is a big jump, and it's come a big jump over the last 20, 30 years, right? I've shown this multiple times with M2 money supply and how that's kind of tapered off a lot over the last few decades and all these other things, right? So you can continue to print more money, and it's not going to give you this runaway hyperinflation that you're scared about. By the way, the CPI inflation we're talking about is not hyperinflation. Hyperinflation is the production of an excess of fiat, right? A lot of people got that totally confused in their heads a few years back when Jack made that comment about how we were going into hyperinflation right now. Anyway, so there's a lot of moving parts here, right? There's a lot of moving parts, a lot of steps, a lot of things going on. And I think that as we've come through, the system is changing, right? So it changes because we rely so much more on credit and debt now. And because we do that, I think you have to start looking at things different. And there's actually an article I want to look at here real quick. That's the individual in there. It kind of says the same idea, right? It's the same idea that nothing stays the same. Everything changes over time. Does that make sense, guys? Hey there, C-Mac. Good to see you. Brian Riley, good to see you too. Let me see here. Yeah. So these are these things that we're kind of watching, right? So if we look at this and we say, okay, well, this is what's going on, right? So what is it going now? Well, the CME FedWatch tool, right, says that the market's expecting 5.5 to 5.75 Fed rate by the summer, right? Now, I posted a link this morning and I asked a question. What was that link here exactly? That link was, let's see here, had to do with the Fed's Bostic, right? And he said that he's looking forward to a 25% basis point rate hike, he says, because he thinks that the central bank needs to be more cautious, right? Hey there, Silvio. And then he also said that he thinks that we could see a summer pause. So nothing, again, people have been talking about the summer pause for a while now. Bostic's on board with that, right? So he said that yesterday, and you may not have understood, but when he said that yesterday, that's why stocks popped higher. Okay, they popped higher right after that. Now he's got a meeting today, or he's going to speak with another Fed President, Logan, out of the Dallas Fed. And so the question is, okay, so obviously the market took it really dovish yesterday, right, when he said that. So the question is he going to maybe sound a bit more hawkish today to try and balance that out a bit? Remember, guys, I told you the biggest thing the Fed has going for them is their mouth, right? And this is why we often have the various Fed presidents out there some of them speak in one way, some of them speak in another, because everybody's like, oh, the Fed's going to surprise. The Fed's going to surprise. The Fed doesn't want to surprise you. If the Fed surprises you, that means you're going to do something that they have to potentially counter, right? If the Fed surprises you, you're going to emotionally go the other way of what you were doing and go overboard with it. The Fed doesn't want that. The Fed needs an orderly market. So for everybody out there that's always saying, oh, the Fed's going to surprise, the Fed's going to surprise, stop listening to that nonsense. Understand in your head, guys. Understand that the Fed does not want to surprise you. They need you to be orderly, because the more surprised you are, the more volatile the market gets, the more you lean one way or the other, which means the more work that the Fed actually has to do. Not just in speaking, right? But actually then being forced, having their hand forced and having to do things, right? Having to raise much higher, the Fed rate than what was expected, stuff like that. Which they really don't, because it's all lagging, right? When the Fed raises the interest rate, raises the fund rate, right? The Fed's fund rate, that doesn't have an immediate impact. That's months down the road. We're still just barely getting into the impact of what they did back in the summer of last year when they had those 75 basis points consistent raises, right? So the Fed doesn't want to be in your face, surprising, whatever. They want to kind of balance your expectations as it moves to kind of hopefully corral you into being what they think that they need you to be. Does that make sense, guys? Let me see here. John D, what's up? He says, my yield curve indicator has gone code red, and it's 8 for 8 in forecasting recession since 1968 with no false alarms. Campbell Harvey said in a recent interview, I have reasons to believe, however, that it is flashing a false signal. Oh, hey, I like that. Yeah. See, it sounds like, because there's things going on, so you get confused, right? Because we have all this macroeconomic stuff that people are talking about that usually indicate recession's incoming, right? But yet we have this robust jobs market, this unemployment rate that's still, guys, you remember me, I was talking about, hey, once it gets down to 3.4, 3.7 area, usually that's a bottom indicator, right? And then usually it flips and turns back up, and we get higher unemployment, up to 5, 6%, something like that. And heaven forbid, in a worse economy, it'll go higher, right? But that was, gosh, guys, that was what, half a year ago that I talked about that. And here we are, most recently popping down even lower, right? Now, when we talk about that, there was the big surprise to the upside jobs report print, right? In January, right? We talked about it, be huge upside, right? But I talked to you and I said, listen, I think there may be that it may be actually just a one-off type thing, right? This January jobs report, right? Now we've got the next jobs report coming out here next week, next Friday. So you guys be ready for that. But I was talking about the idea that maybe it's a one-off, right? And I talked about different ways of looking at it. And if we look at the history, it's still overall coming down, all these things, right? But nonetheless, the market's still there. Inflation is still, even though it's coming down overall, it's still higher than what we would generally like it, right? So this shows that there's still a lot going on, even though we've got all this negative stuff that usually says, hey, we should be in a recession now, right? And that gets confusing for people because they're like, well, it's supposed to be this, but it's not. So what's going on? So that's pretty interesting that he said that about potentially flashing a false signal here. So I like that, okay? Bamboo, what's up, man? Eriquin says, so a lower 10-year means easier market conditions for housing real estate. Is that correct? Yeah, so your lower 10-year means cheaper rates. Yeah, right? I mean, that's basically what it is, right? So as that 10-year kind of fluctuates, as it goes down, your mortgage rates should generally come down. If it's going up, mortgage rates should generally go up, right? But we're up to where we are already here, right? So are we reaching this kind of peakish area locally, right, for the bad stuff and more liquidity coming in, right? So now we're going to switch. So now we go, okay, well, we talk about the Fed rate, right? And we talk about what's going on with that and then the yield curve. And so then we look at, okay, well, what else is going on, right? Because everybody's still really bearish, right? A lot of your really large accounts that did well in the bear market, right? Which again, I want to remind you guys, everybody's an expert in a bull market. Everybody's an expert in a bear market as well, if they figure a bear market, right? Because all it is just saying, listen, we're going to keep going lower. Listen, we're going to keep projecting and keep going lower. I mean, that's all you're doing. Similar to bull market, listen, we're just going to keep buying the dip and going higher, right? It's hard to be wrong when you're in the direction of the trend, right? But it's always that reversal point. Tops and bottoms, that's where it kicks traders out. And what you'll see is that a lot of these bigger traders who were good on the downtrend, right, can't figure out the reversal. They're still bearish now, even though you've had a 60% rally with Bitcoin, even though you've broken out of that bearish market structure coming off the all-time high, stuff like that, right? Excuse me. And the problem with it is I'm not finding any of them yet that really have, an invalidation level. Well, so what are you doing? Are you really a trader? You say you're a trader, but you don't even know where your invalidation level is. Sounds like you're being emotional to me. Yeah, you may be trading it, but it sounds like you're being very emotional because you don't have an invalidation level, which means you haven't seriously considered the other side, right? As a trader, guys, I'm going to tell you right now, if you cannot figure out what your invalidation level is and why, you shouldn't be trading. I don't care if stocks are going, or, whatever your trading is going up or down. You have to know when you get in, where is your validation level? Where is your invalidation level? If you do not know that, especially if you're talking in terms of the longer term trend, then you should not be in the market. Because what it means is, for instance, if you're bearish right now and the market's rallying up, you're going to keep moving the goalpost. You're going to keep saying, okay, well, here, this is it. It's going down now. And then it goes up higher. You go, oh, well, now it's going to go down. And then it goes higher and you go, well, now it's going to go down. And you're going to keep trying to short. You're going to keep getting clipped out every time, right? You don't want to do that. Again, it's the same thing when you're bullish, right? You got to understand where those tops may be and why. You've got to have targets that make sense, that are logical, with a bit of a narrative, a bit of an understanding of why that may happen. But also you have to understand why it may not. And if it doesn't, at what point does the market say, okay, well, you're probably wrong? The problem is most people are so emotional when they're trading that they can't stand to be wrong. They'd rather be right than profitable. I tell you guys time and again, always choose to be profitable over being right. I don't care what social media is doing to you. I don't care what some Yahoo on social media is saying. I don't care how many followers they have. If they don't show their face and they got a fake name, they got some animal picture or something, guys, stop giving them so much of your time. Because, you got to ask yourself, why do people do that? And a lot of people come up with I want to be, whatever, crypto, I want to be anonymous, privacy, blah, blah, blah. Well, you know what? If you want to be private, then don't do anything public. There's a reason, guys, I've used my name and my face, and I've never hidden it from day one. All right? I'm not worried about what some other Yahoo online says. But I am concerned that you do understand that I'm putting it out there, that I'm being realistic with you guys. Okay? Now, just because somebody has a picture, and a name doesn't mean necessarily that they're being, fully up and up with you. But, a lot better chance of that than the other, because the other, if they get wrong enough times, they can close that account, or they can actually have a second account. You would be surprised at how many influencers out there, right, have two accounts. They have a bear account and a bull account. They're making money off you guys left and right, just because you follow along with them and you interact and all these things. That's their money, okay? So just some things to think about, guys. It doesn't mean that all big accounts, influencers or whatever, are don't know what they're doing or whatever. But I'm telling you now, if you've got somebody who's telling you, listen, these are the trades, and they're talking about longer term pictures of what's going on, and they don't have invalidation levels, or they don't have logical invalidation levels, just understand they're trading emotionally. And they're not really a whole lot different than new traders, okay? You guys got to understand that. It's so important, okay? Let me see here. Let me just kind of catch up with you guys. Ryoshi, hold on, buddy. I'll get over to the charts here in a minute. I just want to get through some of this stuff here about the overall macro and what's going on, okay? Fibbo says his invalidation level is when the screen punches him in the face. Lord have mercy. Let me see here. So, anyway, so now we've got that, right? And so then we get on here and we go, okay, well, what's going on? Well, so the one thing is something I've posted a few times, I've talked about, right, is global liquidity, okay? So I know a lot of times people get in here and they talk about, about what's going on in the U.S. and everything. But I've told you guys before, right? I've told you guys before that the U.S., that the central bank has to take into consideration, because the world is so interconnected financially and globally, right, that they have to understand what's going on with the rest of the world. They can't just be this lone dog out here doing its thing, right? They have to consider what's going on globally, especially, not just because everything's so interconnected, but because the USD is the reserve currency. So the central bank here just can't do whatever they want just because. So what does that mean? That means that even though fighting inflation is an important thing to them, it's still secondary to what's going on globally, right? And so there's this great article on Forbes here. And again, this is the global liquidity, right? So you see it reached this peak here, it pulled back, and now it's rallying up again. We talked about this before, right? Where the global liquidity is coming up since October. Who's putting it in? You've got Japan and you've got China, two of the largest economies behind the US, right? Popping in a whole bunch of liquidity, right? Then you have the Fed through its reverse repo facility, who's also now, through that, you're getting liquidity in the global landscape, right? So why is this important? It's important because what that means is there's dollars and whatnot flowing out there, and they got to go somewhere, right? So even though the Fed's talking, we're going to keep raising interest rates and do all this, whatever, I mean, really, they're contributing to that global liquidity, which is really strongly being pushed up right now by Japan and China, right? And again, why is that important? Because the U.S. stock market is where people want to be. It tends to weather better than the other ones, right? So you get a lot of money flowing in from other countries into the U.S. stock market. What else? Well, many of y'all are all about crypto, right? Even though we often talk about crypto almost in regards to it just being this whole USD related thing, right? We're always looking at the Bitcoin USD pair, right? The fact is, the entire world, right? All currencies contribute to Bitcoin, right? So if you have higher liquidity coming in and it wants to find itself in riskier assets, you're looking at US stock market, you're looking at crypto and other you look at Bitcoin and other cryptocurrencies, right? So even though everybody's screaming, recession coming in and whatever, and it may still turn out to be, we can't promise you it's not going to, but all of a sudden you start looking at all the rest of this going, well, maybe things are not as we kind of usually expect them to, right? So if we look at this article, it says, what caused the change, at least for the Fed, was the recent debacle in the UK's sovereign debt market. Remember when the UK almost defaulted on the pensions? Yeah. So investors sold off the government bonds amid a dire economic outlook and political uncertainty. What ensued was that many analysts referred to as a market meltdown in what has historically been one of the safest corners of all finance. Think it wasn't a serious glitch? It ended up costing the prime minister a job. Yeah. So it's no surprise then that central banks are less concerned about reining in inflation than they are about keeping the financial system's gears greased. We are global, guys. Nobody's can operate on their own out here, especially not when you're the U.S., right? And you're the reserve currency and all this stuff, right? So the Fed's going to say what it's going to say, but at the end of the day, it's got to look at how it affects the rest of the world, right? As do other large countries out there, right? Other large central banks. So they're talking about the most important factor above anything else is the integrity of the sovereign debt market. Again, remember, we are a debt-based economy. You have to keep that debt afloat. You have to. Again, if you get to deflation, your debt, which is significant, right? Not just for most of us individually, right? But also for companies and for governments and whatnot, it becomes exponentially more expensive as you get into deflation. So you have to have a bit of inflation running to keep that up, to make it cheaper dollars in the future so this debt is easier to pay down in the future. Otherwise, everything collapses. Huge collapse, right? We don't want that. Central bank doesn't want that. Governments don't want that. Guys, you can talk all the smack you want about wanting the U.S., about the Bitcoin to be all this and whatnot and down with the U.S. financial system, but at the end of the day, you really don't understand what kind of pain that's going to be. Not just for you, for your family, for your friends, for your kids in the future. It's not something that happens overnight and all of a sudden everything's okay. No, if the financial system crashes, if this credit-based, debt-based system crashes, guys, we're screwed for at least multiple decades. So everybody talks all big online about, oh, Bitcoin, I want to become the reserve currency, and it would, shut down the U.S. financial system and all this. But guys, at the end of the day, you don't want that, because it's going to make life exponentially more difficult for you. And if you have a hard life right now, you can't even imagine how much more difficult it's going to become. Okay? This is the reality of a global, interconnected system. This is what we're dealing with, right? Let me see here. You guys liking this stuff about global liquidity and whatnot? I think it's really important because a lot of people aren't getting it, right? So when I first started the Market Breakdown newsletter, right? I did a few months of just weekly discussions about the Fed repo, reverse repo, all this stuff, and how it kind of works, and how banks work, and how liquidity finds its way out from the Fed into the system and all this, right? And I think now is an important time to really talk about this global liquidity, because I really believe like that was back then. And that's all leading into this being the big issue right now. I really do. Edward, what's going on, man? Good to see you, buddy. Let me see here. That would be crazy. Edward says, yeah, if we broke down like that. Yeah. I mean, it really would, guys. I've said it before. Everybody romanticizes the death of the U.S. dollar, right? Because I'm not going to say it's right what the U.S. has done, historically, right? But at the end of the day, if we have a breakdown in this U.S. financial system, it will break down the global system. And it's not going to be an easy fix. And it's not going to be something that happens overnight that you get fixed out of it, which means severe economic hardship. I keep telling you guys about, when we get the next real downturn, right? How it's expected to be worse and last longer than the Great Depression, right? The Great Depression was pretty bad. So, this is the reality of it, right? This is why if you learn to trade correctly, you at least have a chance, right? Because you don't have to depend on jobs which you may lose and whatever's going on with interest rates, all this other stuff. You've got this way that you can potentially make money whether the market's going up or down. This is why I think it's such an amazing skill to guys to have, okay? Hey there, Diego. What's up, man? Kimosabi saying, yeah, in the debt-based system scenario, a Great Depression would be preferable to a financial system collapse finalized. Yeah, but I think even, it's quite possible that next depression would actually be the collapsing of that system. If you guys know about K waves, contradive waves, it seems like we're toward the end of the winter, which means, again, a reset of the system, right? Everybody talks reset like it's some glorified, fantastic thing. It's going to suck, guys. If it happens, it's going to suck. There's no two ways about it. And I want you guys to really understand that, because so many people are out there talking about it, right? Breadlines with no bread, man, I hope not. But, man, there's so much with it, right? So it's crazy. It's crazy things, guys. Contradive, K-O-N. God, I got to think about it. It's a Russian word, guys. Let me see here. You can just look up K-waves. Contradive, yeah. So K-O-N-D-R-A-T-I-E-V. Okay? It's another way of looking at cycles. Okay? And it tends to align pretty well with larger cycles of Elliott wave. So it's a pretty good thing there, right? Your friend Crypto Savvy quit his job to be a full-time trader. Well, I hope he's doing well. I mean, I definitely don't have I think it's a great thing to do. As long as you're consistently profitable, yeah. I mean, as long as you know what you're really doing so that you can, consistently be locking in profits so you make an income, I think it's a great thing to do. A lot of possibility there. Let me see here. Okay, let me check up. So anyway, yeah. So what we're saying here, right? It talks about the most important factor above everything else is for the U.S. and everybody else is this integrity of the sovereign debt market, right? Like he says there, if you get a blast like you got in Britain in the U.S., we've all got a problem. If that happened in the U.S., world financial markets would have crashed. He says you might say very loosely that we're moving toward a world of yield curve control. Inflation is an issue, but it plays second fiddle to the workings of the sovereign debt market. So again, the same things I've talked about previously, you've got, people really kind of being more vocal about now, right? And it helps kind of possibly explain why we're not hitting that recession yet that everybody's been expecting for 6 months or a year now, right? Let me see here. He says measuring capital flows is easier said than done. He says, so this is the thing. Remember when I talked about changing, things change and things become difficult and you have to kind of change with it, right? So he gives an example here. He talks about cash flows, right? Or capital flows. And you used to be able to calculate bank deposits and that was enough, right? So I've kind of hit on it before, guys, a few times about the euro dollar market and the shadow dollar market, all this kind of stuff going on, right? That's been around since the 1950s. But it's really blown up the last few decades, right? And because of that, we really don't know how much liquidity is out there in the world, right? Basically, when you're looking at liquidity with the Fed, it's doing the best it can do, but basically it's U.S. liquidity, what it knows it can track. When dollars leave the U.S. shores and go offshore to Europe or something, all of a sudden the banks over there can start loaning on that, right? So all of a sudden you got fractional reserve banking over there of U.S. dollars over here that we can't effectively calculate, right? So it says here, decades of financial innovation and the rise of shadow banking have turned a simple calculation into an esoteric exercise. Explains why a lot of investors are still waiting for a train that's already left the station. To put it brutally, many people need to be re-educated. If you pick up a textbook, they talk about the rate of interest. That's not how the world works. It's about the capacity of capital these days, not the cost of capital. So when I was in college, it was all about, they were still talking about rate of interest, right? Again, same thing he's talking about here. But as I've come to, get to the point of now where I'm thinking, it's the same thing he's saying here, where it's really about the capacity of that capital, not the actual cost anymore. So I think, again, if you're still kind of looking at what's going on with the world, right? I think you're really you've got to look at it differently now. I don't think you can continue to look at it the same way that we've looked at it up until now. With the, again, simple looking at simple things like the M2 money supply, which again doesn't really capture things like we need it to anymore because, again, you're looking locally. It doesn't take into account other things. It's just this old metric that we used to do. But even with what it does capture today, we see this big fall off since the 90s, where it continues to drop and drop, right? I'm sorry, where velocity, not the money side, but where velocity continues to drop off and off. And so if velocity, the amount of times the same dollar is spent, so I earn $1 and then I use it to pay for groceries at the grocery store, and then that company uses it to pay wages to one of their employees who uses it to eat out, who then we're in Texas, we'll say Whataburger, right? Recently said to be the most healthy cheeseburgers in the U.S. Just putting that out there. I saw that the other day. Whataburger, Texas-based company. But anyway, and then they go and they pay, their supplier, and their supplier then gets it and pays their employee, who then gets it and goes out bowling. So that same dollar used over and over, right? That's velocity, and you want that, right? But that's been on a downtrend for a couple of decades now. And so everybody they go, oh well, look, money keeps getting printed. We need to go hyperinflation. It's going to be all this bad stuff, right? And yet we're not, right? We're not. And part of that reason is because that velocity continues to drop. As long as the velocity continues to drop, you can continue to print more dollars because you're not getting the flip of those dollars, the consistency that you need. So you have to print out new dollars. Okay? So anyway, there's a bigger conversation there. I've kind of delved on it a few times. But, when we look at all this starts going, okay, well, maybe this is why things are doing what they're doing, right? Maybe this is why all these, big time macro people or people who claim to be big time macro people, sometimes on Twitter, it's hard to tell who's who, right? But, this is why they continue to push for that narrative, So that means they continue to be bearish on stocks and on crypto while stocks and crypto continue to rally, right? Does that make sense, guys? So I'm not saying that what I'm telling you here is something you're going to pick up right this second and go, oh yeah, right, you're right, I need to go long or whatever. I'm not telling you to do that. But what I'm trying to help you do is to get to this understand that maybe there's something else going on in there that's not, coming out. And because of that, maybe we're not really looking at what people are kind of looking at. And if you can't figure that out, then if we are doing exactly what I'm talking about here, then we're going to get new all-time highs, and you're still going to be sitting there scared to buy in. So you have to figure out what may be going on first, and then you have to apply proper risk management, guys, okay? If you don't know what proper risk management is as far as trading goes, man, I implore you to join us for just a month, Tier 3, just a month. Get in there and soak up everything you can. It'll be the best money you've spent as far as trading goes, because you're going to get a real understanding of how you should be looking at markets and trading and doing it properly, because otherwise you're going to sit here scared, and you're going to be scared because you can't figure out proper risk management and how to do all this and what may be going on and all that there. Jake can play. You still prefer Five Guys? Hey, I like Five Guys too. I like their fries. You just got a few Whataburgers in KC, thanks to Mr. Mahomes. That's awesome. That's awesome. Healthy burgers, does that mean you can eat 2? Man, I say eat 5. Just don't eat them all at once. Aerocoin says, if you scroll up, I gave my own testimony on TWC. What'd you say there, man? The amount of quality, free content Chris provides is unmatched. He doesn't just discuss charts, but he's experienced and knowledgeable about macroeconomics. I'm grateful you ran that Christmas special last year for TWC. I work a lot of hours, so I haven't been able to take full advantage of it yet, but it'll pay for itself easily just following your trade signals. Thanks to you, sir. Felt like that needed to be said. Oh, I appreciate that, man. Seriously, I appreciate that. I really appreciate when people, take time when they're happy with something that we do and they take time to actually mention it. It's easy to complain. Most people online complain, right? Most of us do that. It's easier to complain, right? If things are going good, we don't really feel like we need to say anything, right? But as a business owner, obviously, I really appreciate when you guys take the moment to if you're having a good experience, to kind of mention that out there as well. So I appreciate that. Thank you. Juicify, what's up, man? Let me see here. What else? What were you saying there, man? You said there's nothing healthy about Five Guys except for the peanuts you eat while waiting for your burger. I like the peanuts too. The habit burger is fire. I don't even. Oh, okay, yeah. Okay, now I see what you're saying. Ben Huevos, what's up, man? I haven't talked to you in a while. He says, I don't know if you looked at gold and silver already, but do you think lower still? Oh, I've talked about that many times. Yeah, I've actually been looking at the idea that it's probably going to go higher. Yeah. Again, guys, I'm the guy that was talking. I've been pacing out the silver and gold moves right here since 2018 publicly, right? And I was looking for potentially like a big lower low, like some large flat from 2011 until now, right? Hit down to around $1,000 or something. But as I always tell you guys, would you rather be right or would you rather be profitable? You have to, as a trader, understand when there may be an invalidation in what you're looking at. And that's what I talked about a few months back, at least, guys, remember how long ago it was, where I said, listen, I'm looking at the idea that we're probably going to go higher for a new all-time high now based on the price action. So yeah, for sure. John Andrews, what's up, man? You said lifetime membership paid for itself within a few weeks. I appreciate that, man. Seriously. Yeah, so here we go. So we had this big drop here, right? And so we had this kind of going in here. And I'd been talking to, Discord, talking about, man, so we're getting this kind of overlapping thing here. We're not getting real movement. What we needed to see was this breakout up here is what I was talking about, right? And kind of getting this move. This is, well, let me see here. Actually, I was looking at, where was I actually looking at? I think it was like 24, was it 24,000? Is that what it was? Is that this up here? Let me see here. That's 25. Basically, but I was looking for this move that we had to get like this breakout. I think it was like right here. right around this area, somewhere in this area, that we had to really kind of get breakout above, right? And I said, until we do, we got to be ready that we could drop down lower. And I gave some targets. And so right now, we're finding support kind of at this 78.6 retracement, right? Now, I haven't really had to change the count overall. I've still got this as a 1, 2, a 5 potentially. But again, we need movement up, right? So what we need is a breakout above this. Really, I'm looking at the daily pivot. I want to see an impulsive breakout above that daily pivot. And I want to see it pull up above this wave 4 here on Coinbase that's right around. There it is. That's what I was looking for, the 24,000 right there, right? If we can get an impulsive breakout that takes that out, then most likely the bottom's in. The count may need to be adjusted at some point, right? This may be actually 3 and 4 here, right? 3 and 4. Because this pullback would actually be then around 38.2. So I've still got that possibility. But either way, whether it's 3 or 4 actually here or 1 and 2 or 5, if we can get that impulsive breakout above the daily here and carry above that 24,000 mark there, I think we're good to go for our new all-time highs. So based on this current count, that gives us a minimum expected wave 3 of 5 target here at 28,270 and a secondary target at 29,750. Either way, we're getting a wave 5 up into that 30,000 area, which is something I talked about, right? Let me see here. Where's my other chart here? All right. So if you draw this pitchfork, right, and this kind of came off here. I had it more or less set on there. You can see that it's done pretty well here with the price action, right? So the main pitchfork are the red and black thick lines there. These are the outlier, 1.5, 1.75, 2.0. And then, again, same thing here, 1.25 or 1.5, 1.75, 2.0, right? So we've got this great stay within this. You can see that we pulled back. All we did really was we pulled back to the S1 pivot, right? So we came in sideways between the pivot and the S1 on the hourly, reject the pivot, came down to the S1. Again, when I'm teaching pivots, this is what I'm teaching, right? I'm saying if we get this to this, what we're looking for is a breakout higher to signal that we're going to rally up to new highs, right? Over what we had here, our previous swing high. So that's what we're looking for now. Again, if we do break down, again, we could be looking at, at that 19,000 area even. And why is that? Because the assumption would be something I've still been talking about, which is the idea that maybe we've got 5 waves up. Remember, initially it was like, okay, well, this was our initial target area right up there around that 25,000, right? As maybe 5 waves up. And then we look for a 50 or 61.8 pullback. Now, if I do this, the 50 right here is right here around a high volume node. 61.8 is a higher high volume node, right? I'm okay with either one. But until we're actually breaking down toward there, until we're, while we're still above this swing high, I think we still keep that chance about, rallying up higher. And so rallying up higher then takes us through this low volume node area here, right? Again, low volume nodes tend to act as magnets, pulling price through them up to the next high volume node, which gets you up here around 29,000, 30,000. Now, even in doing that, depending on what's going on here, we could still see some continued rally, right? Some continued subdivision. And if we got that, I wouldn't be surprised to see it rallying up here, even potentially toward 40,000. Okay? Now, again, if we look here on the weekly chart, right? Again, from down here at the bottom, this has always been the initial target. But if we break impulsively through that weekly pivot, secondary target becomes that R1 pivot area. It's exactly what, that's that potential 40,000 area. And if you get that area, 5 waves back then, get you 50% at the pivot, okay? So I've got a Pivots Master Course I'm going to be putting out there soon, guys. And I'll give you information on that. But I'm going to give you a chance to get it a lot cheaper than what it's going to be when it's released. I'll let you guys know about that. But this is one of the concepts that I teach in it. It's one of the basic concepts of trading pivots. And there's going to be a whole lot more in there. A lot of things you guys have probably never even heard of, even if you've been doing pivots for a while. So guys, be looking for that, okay? But nonetheless, so this is the thing, guys. Either we reject here, we pull back, and then we break out higher, or we break out above the pivot, hit that R1 on the weekly pivot, pull back to the pivot area, and then break out higher. I think if you're bullish, those are your two scenarios, right? Now, it doesn't have to stop at the pivot. It could go a little bit higher here toward 45,000 or something. But the idea is basically if we're breaking out impulsively above that weekly pivot, we should expect price to rally up toward the R1 pivot area. And again, in doing that, with Elliott wave should give us 5 waves up. So if we do that, then it's possible this could still be wave 3 still extending here toward 30,000, 32,000. Then you pull back for wave 4 to the pivot. Wave 5 goes up to the R1 pivot. And that gives us 1 wave up to the R1 pivot. Wave 2 back to the pivot. Break out higher. Otherwise, we're here. We're 5 waves up. We pull back down toward, this high volume, this shelf area here, right? It's high volume node area right around 19,000 maybe. That's the 61.8 area of this rally. 1. Golden pocket reversal for wave 2. And then we break out higher. Forget all the local counts and everything, guys. That's the same thing I've been talking to you guys about since we've been down here. I was talking even before we had the New Year's pivots. I said, watch when the New Year's come out. I said, we're going to watch for that pivot. Either we're going to reject it at it for wave 1, pull back for wave 2, and break out for wave 3, or we're going to get an overextension on wave 3 here, carries it up toward the R1 weekly pivot, where we complete wave 1, pull back for wave 2 to the pivot, and wave 3 up, okay? Does this guarantee the price goes up? No, of course not, guys. Of course not. But if you're trading pivots, what I'm teaching you right here is worth gold. I'm telling you guys. Pay attention to it. It's something that happens over and over and over again. People usually don't pay attention though, right? But y'all are paying attention, right? Taking that free advice there. I would do that. Or it's that free education there, right? So that's what we're going to see. Now, obviously, inefficiency, large push down, right? So we've got an inefficiency right here locally. We kind of get above that, and when we need to work our way back up. Right now, again, the count still works. We're only at the 78.6 retracement, right? So following the rules and guidelines of Elliott wave, we shouldn't become instantly bearish, right? Because wave 2 still works as we would expect. It works as a flat, right? It would be ABC down, ABC up, then 1, 2, 3, 4, 5 down here, right? And it works as ABCs, as a ending diagonal. Most of the time on a flat, your wave C is going to be an ending diagonal, whether it's a wedge or an expanded wedge. Either way, it's going to be an ending diagonal. It should come down in ABCs. ABC is 1, 2, ABC is 3, 4 back up into 2 and 1 there, and then ABC down for 5. Okay? You've noticed that S1 is higher on a lot of other exchanges. Well, give me an example. They can't just say a lot of other ones. Got to give me an example, okay? So I can check it out. But yeah, again, you want to use the exchange you're on, guys. I often get this question, well, where can I find all the liquidity, all the volume as an indicator? Don't. There's no reason to. I don't care what somebody else out there tells you. There's no reason you should have all of the volume across crypto on your one, Coinbase chart or whatever. Because you're not looking, when you're looking at this, you have to look at volume and price action specific to Coinbase. You're on this exchange. Also, people ask, well, which charts or which exchange should I be looking at? You should always trade whichever one that you're trading. That's the exchange you should use. If you're trading on Coinbase, you should be using Coinbase. I don't care what Binance or something else is doing. Your money is on Coinbase. It's what you should be looking at. You shouldn't be looking at Bitfinex or Bitstamp or whatever, Bybit or whatever it happens to be. Use the chart for the exchange or broker that you're using. Whether it's for stocks, crypto, futures, whatever you happen to be doing, Forex, use your broker, your exchange's charts, Not any of the other ones, okay? You're not going to get alpha looking at some other charts. It's not going to help you with your trade. Okay? Let me see here. KuCoin. Let's see what you got here on KuCoin, right? Let's see. USD. I guess it's a USDT, right? So first of all, it's not USD, it's USDT, which is a synthetic, right? It's a peg. It's not actually the dollar, right? But generally, I mean, it's a toss. You're right there, right? At the end of the day, on both these, on all these charts, you got this liquidity drop right into your previous support here, right? On all of them, that's what you did. Yeah, you're a little bit below it. The other one, you're right on top of it. But still, you're right there around it. So, you kind of look at that as what it is. If it makes you feel better and you get a close above it, okay, there you go. But if I'm looking at this, I'm not so concerned. It's just right there, right? On the other one's just on top of it. Because when I look at pivots and things, right, I'm looking at, this area around it, right? A little bit above, a little bit below. They're not finite lines. They're ranges. They're like elastic, like rubber bands, okay? Yes, it's a finite line printed based on closes and whatever, but as far as price action goes, it doesn't observe that as a finite line because you have volatility. And volatility can push you down through it and then pull right back up, right? So you have to understand there's like a range around these things. And, that's the way you should be looking at it, right? Now, the only thing that changes on that is if you're using like Elliott wave, right? Elliott wave says, listen, if wave one is done, then it is done right there. You break out above that, then okay, right? There's no range. It's not like, oh, it broke out a little bit above, but it's okay. Or, you go, well, here's wave one, and wave two dips below wave one. And you go, well, there's a little bit of a range, so it's wave two. No. Specific rules for Elliott wave say that, wave two cannot drop down below wave one. But generally, when you're looking at areas of support and resistance in general, you should expect a bit of a range, a bit of a fluctuation area in there. Because, again, volatility. Okay? So, I mean, that would be the way that I would explain it there for you, right? And of course, because USD and USDT are two different things, right? You guys understand that, right? USDT is not USD. It is a pegged product, which means it's still, even though it's there, it doesn't stay precisely at 1-to-1. Sometimes it dips a little bit lower, sometimes a little bit up, right? You can look here at the, let me see if I can get this pulled up here. Right here. Tether against the dollar, guys. On Coinbase, right? Look at this right here. February 14th. Look at that big spike up there. Right? It doesn't stay exactly at $1, right? Kind of changes. So when you're looking at USDT charts, you shouldn't expect them to be exactly what the USD charts are because of that, okay? Let me see here. Don't let Hank hear that argument. Yeah, I know. Hank's got his... Can't teach an old dog new tricks, right? Hank's okay guy. But, again, I tend to stick by... These things I explained to you guys, what I have found is, almost 30 years of doing this, that these particular things I'm saying have been what make me profitable, right? I find that veering off these things that I say tends to lose money. So for me, it's all about, this is the way I understand it and this is the way I look at it. And then that way, it keeps me where I am, right? So, but, Hank says he does pretty good and that's okay. He can do it his way, of course. My way, I tend to be more rigid about these things because, listen, if you've got more rigid rules, then your chance of actually becoming emotional are lessened. It's when you have kind of shady areas, when you have kind of gray areas that your emotion finds a reason to come out and gives you more of a chance of changing something, right? If you say, well, when it does this, then it may kind of do this thing right here. Well, then it goes, okay, well, did it or didn't it? And you have your stop loss and your targets and whatever, but then you start moving them around because emotion says, well, maybe, rather than, listen, this is definitively the way it is. And if it does this, then you should be out or you should be in. It gives you less wiggle room with your emotions. That's why I'm a big proponent of more strict rules and whatnot when you're using a system or understanding the way that things work. It just gives you less of a chance of having a reason to become emotional and change things around. Does that make sense, guys? All right. Let me see here. We got the DXY, right? What's going on with the DXY? You guys been watching it? All right. So we have this move down, and then we have this move up. You know, is this maybe a 1, 2, 3, 4, 5 here, and then ABC that, you know, kind of gets up here around the 85.4 and breaks back down. It broke down below the hourly pivot, tried to go up immediately, bearish engulfing right back down. So when we see something like this, usually it indicates we're going to continue down lower. If this is one down, I mean, I could also potentially see maybe like a 1 and then an A, B, C as a flat and coming down. But for right now, I'm unsure either way. But right now, I'm going to go with the 1 down here. Gives us a minimum expected wave 3 down here at around 103.137. Secondary down here, target of 102.660. Nonetheless, what I'm looking at is for it to continue lower. Now, because we've dropped on down through that hourly pivot area, that suggests that wave 2 is likely complete. But we want to see a breakdown below this swing low right at the weekly pivot right there, right? That's the 104.272. We want to see a breakdown below that to add confidence to the count. Until then, if we do break out, well, then we can still be looking up higher here. But for now, we want to see if we can get this continuing to break down through this range area, through that swing low, lower here, right? So the 1 hour, we've got RSI, room for it to fall further. Stoke RSI hasn't quite hit oversold yet. 4 hour, as you can see here, we've got a long way to go with RSI and Stoke RSI. The 4 hour showing this move up and immediately this big bearish engulfing move back down. Looks like we have these pin bar candles up here toward the top of this rally up. So, you know, right into resistance, suggesting that that's a reversal off that and not just a pullback. So again, looking for that breakdown locally here and then breakdown below what I said. Continue going lower there. If we look at the daily has a long way to go on RSI. Stoke RSI still has a bit further to go there. We are sideways between the pivot and the R1. So on the daily, again, talk about what I was talking about before. If we get a hit to the pivot and it breaks back out here above the swing high, we should be looking at the R1. And at that point, I'd be looking right up here, probably around 106.9 or so as the target. However, if we break down through the pivot, then locally what I want to see is a breakdown, a rally back up and reject, and come on down to the S1. Now in this case, what we've been looking for is a move down toward the S1 pivot area, a move back up and rejection of the pivot, then a breakdown further. Same way we were looking on Bitcoin on the weekly, a breakout through the pivot to the R1 and pull back to the pivot and then break out higher, right? So if we're to do this to the S1 pivot, 50% rally gets you back up to the pivot. Same idea, just the other way, guys, okay? And potentially, you know, a 61.8 if you're getting down a little bit lower down here toward this kind of this close right here, about 101.15, 101.14. Still get you a 61.8 there. So that's what I'm looking for. You know, I look for a breakdown right into these wicks here. Again, that's where my wave 3 is, right? And you get a 4, you get a 5 down here maybe. But nonetheless, however it counts coming down, what I'm looking for is a move down here, rally back up, get rejected the pivot, break down the S1, maybe rally back up to the pivot and continue down further, depending how far into the month we are. So losing that daily pivot should have us heading down there lower, right? Again, we could actually be with a 1 and then a flat as a 2, which would get these targets up here a little bit more, which may get like a 1, 2, 3, 4, 5 down here, which gets us a 1, and then a 61.8 retracement, potentially, or even just the 50% right there. Then heading back down for 2. Does it make sense? Fibbo says still a bear zone on the DXY, 4 hour for him. So yeah, so for Fibbo's threshold that he uses theory, what he's saying is he's looking for further downside. It's still bearish. It still should expect, the DXY to continue lower there. So that's good. Eriquin says the daily looks weak. Top at 105 right there. Yeah, I think there's probably a good case for that. Again, this is my, it rallied up pretty high here, but this is my daily, I think it's the daily supply structure right there. Yeah. And all we did was hit the EQ of that. See that? Got rejected. So, and now we've fallen out of the ascending channel. Fallen out of, we kind of retested as resistance. Kind of coming down on there, right? See that? In case you weren't paying attention to it first off. So you broke down impulsively, right? Came back up, retested, got rejected on wicks. Got a nice pin bar set up there. Settle down here. You got a pin bar here, a little bit of support, but getting rejected and coming back down. So again, looking for that to continue further. It's not a pretty looking 8-hour candle right there if you want to look at that. Starting to cross bearishly. But nonetheless, expected for it to continue further now. So, and if that's, again, if the DXY is falling further, that means the dollar is losing against its basket of currencies, which means, things like, generally the yen's been a difficult play, guys. It's been kind of doing like the dollar here, step around, but the yen could be just about done on its or the dollar against the yen on the rally there. So the yen could be starting to come in more dominant now. On your Euro USD pairs, you'll probably see the Euro rallying against the USD now. If you've got the cable, the Great British Pound versus the USD, you probably see that Great British Pound rallying against it. So yeah, you got a lot of that kind of going on there if you're trading Forex markets. Let me see here. Okay, you may have heard recently Dow theory. Dow theory basically says, and Dow theory is based on the Dow versus the Dow transports. And the idea is when you see the two indexes diverge, okay? And so it usually means price is going to be the opposite, right? So here you go, you've got, this is the Dow right here. You can see that it made lower highs. You can see that the Dow transport made higher highs, so there's a bit of divergence there. Doesn't guarantee that everything's going to come down lower, right? But you need to watch that when it happens. I think the Dow transports look stronger. I think we're going to see this just be a temporary thing here. You can see that on the weekly, all the Dow has done is pull back into this candle right here. If you guys are members of Tier 3, you know why this candle is important. Okay? But anyway, all we've done is kind of pull back into that candle. It's right there at the weekly support. We're finding support there. If that thing holds and we break out above here, there's absolutely little to no reason why you shouldn't be thinking new all-time highs based on this weekly chart here. But I think we'll get this following back up along with the Dow transports here. I think they'll both kind of head on up there. So we'll see, But again, the Dow has broken out above that mid-August swing high. We're looking for the S&P and the NASDAQ to do the same. And doing so, we'll kind of lock this in as 3 waves down. So you got a leading diagonal here as wave A, ABC up for wave B, and then 1, 2, 3, 4, 5. It's wave C there, short wave C. Breaking out above it would suggest that this is all corrective, and overall, we're going to have new all-time highs coming in. There's a couple of different ways that could play out. I've talked about those before, so I won't go in again here. But ultimately, that would suggest that it is going to be corrective. We'll look higher, right? So don't be surprised. Stocks continue to rally up, right? Let's see here. Gold. What are we at with gold here? So gold, let's kind of get all this other stuff off here. Getting a nice rally this morning. We want to see an impulsive breakout. Well, we won't see it on, the daily. Yeah, we want to see an impulsive breakout above the daily, as well as then this is kind of this is our make or break area right here, 1902 and 30 cents. If we can break out above that, that should suggest this is 5 waves down, or I mean 3 waves down. Locking that in is corrective, and we're looking for a new high coming out of that. So that's what we're going to look for. If we get rejected the pivot, look for a potential loss of support here and head down to the daily S1 pivot. But as far as weekly goes, look what we're doing. High volume node, dropped on down, 3 waves down into it. Large weekly engulfing candle right at the pivot. The pivot's said to hold this support now, even though we dip below it, because we dipped down in a big, in this candle, and immediately the next week right back up, engulfing that candle. That says that the pivot's held as support. Really, it's this high volume node here. But as long as we're above that, we should be thinking about higher, guys. Okay. If I look at this on the weekly, I mean, it looks like could potentially be 1, 2, 3, 4, 5 still to go, right? Just looking at the weekly here. And so again, we would expect to find some resistance in this wick here, probably closer to this area up here, which gets us the R1 pivot. So again, the idea would be wave 1, 2, 3, 4, 5 gives us 1, 2, 3 up, right? Remember, in Elliott wave 2 generally retraces to wave 4 to the lesser degree. That's our initial target. It happens to also be at the pivot, high volume node. So again, I'm thinking, whereas before I was thinking maybe this was a top here and we were going to come on down, it looks like this may be at least a 3 and a 4 down here as a flat. And then this would be 1, 2 of 5. 3, 4, 5 still to go higher. So that's what I'm looking for there on gold. Okay? You can also see on the weekly we've dipped down into oversold here. You can see that that's the Stochh RSI. You can see that RSI is finding support right around the right here in the neutral area, right around 50. The neutral line. Do I still anticipate sub 1,000 gold and $10 silver on the macro? Has that count been invalidated, or was that not only a possibility if we got a bust in there? Yeah, that's what I was talking about earlier. This is what I changed a few months back when I said it looks like maybe we're actually going to make new higher highs. And I was iffy about it at first. I was kind of, still looking, okay, maybe we're coming down lower. But overall, the breadth of this rally, and now seeing this pullback here and this bullish engulfing printing, and I expect we'll probably see new all-time highs now. Yeah. So, yeah, what I was looking at before, potentially maybe this being part of a large flat here, right? Expanded flat. I'm now looking at likely being like a 1, 2, potentially like a 1, 2, 3, 4, 5, or I don't know. Some part of me says maybe this could even be like a 1, 2, 1, 2, 3, 4, 5, 3, 4, 5, right? Those two ideas, right, would be the difference between, do we have a blow off top like in stocks and whatnot this year, right? Or do we continue on for a few years? The idea that, that this is 3 and 4, or maybe this is, just starting out with the 5 overall, the last a few years, the big macro look. I'm still not sure which one, but I'm again, I'm looking at starting to really kind of look at the idea that maybe we get a few years out of this rally, and then we get the blow off, not just immediately here. There's not enough that's come in for me to say we definitely don't get a blow off top this year, but I am starting to look at other things and see that maybe we might end up going for a few years, which would then go in with the next Bitcoin cycle, which could be interesting, right? So we go up for a few more years, stocks make new all-time highs for a few more years, cryptos do, dollar continuing lower, and then, and gold and everything else kind of, I don't know, we'll see how it plays out. But yeah, again, I don't necessarily believe that gold is the kind of idea that this hedge against what's ever going on with the dollar kind of thing. I just see the gold as a market to trade, guys. So before you ask, but what the dollar's doing this, how can the gold do that? Well, because I don't see them in the same markets. I see that they may, be inverse at times, but I don't think historically there's enough evidence there to say that the gold is this protection against the dollar, against inflation and whatnot. But we can still trade it without worrying about that, right? We can still trade it without worrying about that. And if, and still there is that possible narrative there, right? What we were talking about earlier. If they become more obsessed, or more with the whole global interconnection thing, right? Keeping everything flowing more so than interest, right? Or inflation, we could see inflation continue to creep up as the Fed's hands are tied because they got to work with the whole global thing, right? And so if it's doing that, then of course, again, you see gold continuing to rally, right? So there's a couple different ways to look at it, but I don't really look at a lot of correlations, guys. A lot of people out there are going to talk about correlations, and I think it's a bunch of nonsense, really, because they're always talking about the correlations when they work, right? Oh, but look, Bitcoin was correlated with NASDAQ over here or over here. Well, yeah, but if it's not anything that's consistent, I tend not to use it in my analysis, right? Because if it's not something that happens consistently over time, then what value does it add? It doesn't add any value, right? So we'll see what happens with all this. So yeah, what's up, Hank? Good to see you checking in. Let me see here. Yeah, watch out for correlation bias, Fibbo says. I agree completely. Hey, by the way, guys, y'all liked having Fibbo on last week, right? So Fibbo and I are looking to maybe do like an every other week thing. So if he's still good for it, he'll be on again next Friday. Let me know what you guys think about that. I think it was a good time. It was a good show, even though I was kind of stumbling around with the new software. With that. So yeah, that's what I'm kind of looking at here with gold on that. The other thing I wanted to look at here, let me see. Oh, what did I just do with it? I had it. Oh, well, it was an oil chart. Let me see here. Well, let me look at MicroStrategy here real quick. Again, my account was basically the MicroStrategy bottomed out here on a wave C on the way down, right? Or could potentially be, a WXY, right? Kind of thing. WXY or even, 5 on it. I think that ends up being wrong there. 1, 2, 3, 4, 5. Yeah. That was a holdover from a WXY count I was looking at. So, okay. So we get 1, 2, 3, 4, 5 is ending diagonal. We rally up, right? Look what's going on. Again, because MicroStrategy has so much Bitcoin, we should expect, if Bitcoin's doing well, MicroStrategy in general should expect to rally as well, right? Same thing with Coinbase. Again, I keep telling you guys, Hex, MIGI, potentially even NVIDIA, stuff like that. As crypto goes higher, these kind of crypto-related, Marga, Riot. I can't think what it's called now. I said Marga. I didn't mean Marga. I can't think what it's called at the moment for my mind. But anyway, yeah. So the idea here that we would head up, right? So what's really happening here? I mean, here, all we're doing, this is support, guys. So all we're doing is kind of pulling back to that support there. High volume node under here. Man, if we can get a impulsive breakout above the daily pivot, I think we should be looking higher. If we look at the weekly, where are we at on the weekly? We're right at the weekly. Again, breaking above the daily will carry us above the weekly. Looking higher, right? Based on the height of this channel here, the target would be up here at around 877. Right up here in this resistance. Almost perfectly at that R3 weekly pivot. So, not seeing too much to hate on at the moment. I'm not a big fan of what's his face. But, the chart is what the chart is, right? Mara, thank you. Mara, yeah. DigiHost, yes. Another one there too. Yeah, you guys got me with Mara. I appreciate that. Do I have a recent Wyckoff chart for Bitcoin and or SPX? No, I have the one I posted, a week or two back there for Bitcoin. I don't have anything more recent now. So yeah. Kind of what we're looking for there with MicroStrategy, right? And then the oil. I just wanted to see if I got that oil thing here. I was looking at. Well, we can just pull up this right here. Look at that. So I noted this morning, if you guys were watching Twitter, man, this would have been a great futures trade, guys. Let me see here. 4 hours ago. 4 hours ago here. I posted this chart, right? It's right here. And I said, good morning, folks. Who is long oil this morning? Looks like a great opportunity after the drop we just had. Right? Talking about oil. There you are, Dan. Dan. And so, we get 3 waves down, right? We had this nice rejection here off the pivot, right? That's the 4-hour pivot, hourly pivot. And then an hour later, printed this here. I said breaking out above basically this right here, this swing high right here, this A, B, C wave, so this A wave or this B wave. I said we'll signal continued rally higher. And so here we are, guys. So it was a great trade this morning, a great long on that, right? But yeah, I think we're looking higher. This is a great combination. You got this great pin bar here. It's rally right into support, and this huge bullish engulfing candle in the 4-hour there. How's that daily look? Look at that daily. Pull back right into this candle right here. Which is just below that daily pivot, taking off like a scalded cat now, right? Breaking out above this resistance right here on this bullish candle here. You're getting a large candle spread, comparatively. You're getting a spike of volume again through this resistance right here. You got a touch here, touch here, touch here, coming through that. So. The next goal is going to be a breakout of this 82.5, 83 area. If we can get that, there's no reason not to look up here around 92, 93. And then we're kind of at this kind of area. We're kind of getting just above. And all of a sudden things look kind of interesting. You see how we're finding support right around this area here. And so with this, again, this is along with, up here, I've been talking about this being the top for a while and looking like, I've given some scenarios where we could see like a really possible lower low coming out of, or not lower low, but, a significantly lower low, or low anyway. Keep saying lower low. Down $30 or more even. But as I watch this now, things are getting kind of interesting. And so I want to see how does price action happen around this $90 and $100 level. If we're moving back up there, that suggests potentially, 160 or more coming in for oil. But the only way oil really is going to kind of do that is if we've got production coming in, which means people buying, companies producing, right? Travel in, you see, what are they called? Airplanes, right? And cruise ships going, right? So we're going to kind of watch to see how that all happens. But right now we're at an interesting place, finding support around support here where we'd expect, right around the highest volume node. We'll see if we can get a breakout here. All of a sudden, then we're looking up here. If we can get a breakout, the volume just continues to drop off, right? Get up here around 100 is the next one as we were talking about. Then 110, and you're really setting up for a potential move out. So we'll see what happens with that. But I think for right now, the trade is up with oil at the moment. If we can get that bullish breakout above that weekly pivot, again, that's that $92, $93 area. Bullish breakout above there, we should be looking at the R1. That gets us up there around 117, potentially 120. And again, do we get a 1, 2, back up, right? If I look at this, this could be a ABC, ABC, ABC. So it could be a WXY kind of thing here, right? You know, it's consolidation. Could potentially be a triangle, but I mean, as we look at it here, this would have to be A up here, right? So this would have to be B, this would be C, this would be D, and then this would have to be E, right? So if we get the breakout, again, looking for the breakout out here, if we get the breakout above 78.45, all of a sudden we look at A, skinny little B, drawn out C, and then it starts looking weird. Doesn't have the look. But we can continue to maybe look at it as an A, you know, a B, and then a C. But if it breaks out above the swing high up here, then it's definitely not a triangle, right? 82.64. So we're looking for, if you think this is a triangle, if it breaks out above 80.62, it's telling you it really may not be. If it breaks out above 82.64, it's telling you it's definitely not. Now, if it is, right, if it is, then you're just looking for this breakdown probably right around $64 here, $65. I think would be the target on that. And of course, falling through further than that, you know, you look down here at the S1 pivot on the weekly. That simple two targets like that's what I would look for if we did break down below this swing low. But again, if we break through that one and that one, then I'm looking at the pivot. If we break impulsively through that, then I'm looking at the R1 pivot. See how easy trading is, guys? Well, see how simple it is? It's always simple, but not easy, right? So there's kind of where we're at, guys. I need to get out of here. But as always, I appreciate you guys checking in. You know, the only thing you control is how much you lose. That's it. I hope you guys got that down. I hope you've been here enough times that you're dreaming that. Because that is probably one of the biggest things you can understand in order to be a better trader. I mean, if you don't understand that, if you don't accept that, if you don't live that, you're going to have a lot of trouble being consistently profitable. But as long as you get it figured out, things are looking pretty good too, right? By the way, also notice big resistance coming down here through oil, right? So popping up through this area is going to take us through that resistance. Again, if we can do it with, you know, with impulsively, with larger candle spread, larger, you know, volume spike coming out of it, big ink. So next week would have to be the week we'd want to see that kind of breaking out. So yeah, there we go. All right. Listen, guys, you can join us always at howtotradetowin.com. We'd love to have you there. More specifically, howtotradetowin.com/LMT. That's our mentor program. It's a year long. It's going to do everything I possibly can to help get you into the right mindset, to get you through the emotional and psychological issues that you have, while at the same time teaching you profitable trading systems and teaching you a bigger understanding of all this kind of more along this macroeconomic lines and things that happen on the chart that you should be watching out for to kind of give you an idea of what may be going on, okay? A whole bunch of other stuff. Just head over there. You'll see it. If you got any questions, again, you can always email me at christopher.inks@texaswestcapital.com, or you can follow the Discord link at the beginning of the video, and I believe it's underneath the video as well. And you can just send me a DM over there on Discord. Yeah, that's it. Do that, okay? Other than that, guys, man, I hope you guys have an amazing, amazing weekend. I hope you trade safe. I hope you take a little bit of time away from the charts. Remember, as traders, it doesn't really matter what goes on when you're not on the charts, when you're not on the clock, right? Treat trading like a business. Work the hours that you're trading, and that's it. Don't let it consume your life. That's the second biggest bit of advice I can give you other than about risk management, is don't let trading consume your life. It's not worth it. It's not going to help you out any. Staring at the charts 24/7 is just going to get you stressed out, which is going to make you more emotional, the one thing you're trying to not be. All right? All right, guys. Y'all have a great weekend, and I will see y'all there on, oh gosh, I guess Monday, right? If you're in Discord, you guys know what's going on there, so I will see y'all as soon as I am able. Take care. Thanks for tuning in, everybody.